morning from just outside Washington, D.C. in the U.S. right now. And good evening or good afternoon, wherever you are. It's great to see so many of you. We really appreciate you taking 2.5 hours out of your day to join us. What I could say is that it's really important that you have, because we really need your voice as we help to construct our projects on fraud and going concern. This is our third roundtable. For those that don't know me, I'm Tom Seidenstein. I'm the chair of the IAASB. And as I said, this is a third of our roundtable on this topic. And the idea of these roundtables, in addition to the discussion paper, which we wish everyone to comment on, is to get some rapid feedback on what we should do and how we should scope any work that we do on fraud and going concern. And let me just say that in my discussions since I took the chair role in July of 2019, that these two topics seem to come up every time I meet with someone. And that's a pretty good indication of the public interest in these two topics. So our idea is to get a really well-researched, tightly scoped approach to these projects so we can make rapid progress if that's what's needed from a standard setting perspective. Today, one of the benefits of these roundtables is to get feedback from groups that maybe whose voices sometimes aren't as heard as much as they should be in the process. And the focus today is on unique aspects of fraud and going concern and audits of less complex entities. So I appreciate you all being here and sharing your knowledge on that topic. The good thing about being in a chair is that you get a lot of help. And today I will get lots of help from Kai Mortataglia, one of our board members. But importantly, he's playing the role of moderator in this roundtable and is leading, chairing the LCE project working group right now. So I thank Kai for being willing to do that. So with that, I thank you for joining us. I thank everyone who's watching us on YouTube right now. That's a plug for our YouTube channel. If you ever want to watch IAASB Matters, we stream everything we do on Zoom via YouTube. And I turn it over to Kai.
Thank you, Tom. As you said, my name is Kai Mortenhagen. I'm being the moderator for this call. I'm also the of the LCE working group, working on the less complex entities. As you know, today's session will focus on fraud and going concern related to less complex entities. So if we go to the next slide. And here we have the agenda. As Tom said, we have about 2.5 hours scheduled in our diaries. The first part will be relating to unique aspects of fraud related to LCEs, and then also the fraud procedures that are done on LCEs. So unique aspects of frauds related to LCEs. We'll have a 15-minute break at 8:15, and then we will have the second part of the discussion being related to going concerns. There are also unique aspects for LCEs related to going concern and the work that the auditors do. Also then on the procedures that are being performed and if there are differences in the practical application of the requirements for LCEs and other entities. So, but I think we can move to the next slide. As you've seen from the paper and the discussion paper, there has been, and also media, there is some recent high-profile corporate failures. So there's been a lot of attention on what the auditors do relating to fraud and going concern. But fraud and going concern also relates to less complex entities and small businesses. And one of the Association of Certified Fraud Examiners released a report in 2020 where they said that the organization will lose an estimate of 5% of their revenue, a big number, $4.5 trillion globally to fraud each year. Many of those might relate to high-profile corporate failures and audit failures, but it's also relevant for small businesses. In their report, they also say that the small businesses, they have the highest median loss due to fraud of approximately $150,000 on median. So it's a big number for the small entities as well, and it will have serious consequences both for owners, employees, and also a lot of other impacted parties. The work that we are doing now with this roundtable, it will inform us in many different ways. It's information gathering activities at this point. It will inform us on the LCE project, both in relation to the development of a separate standard for audit of LCEs, but it will also inform us on the consideration that we're doing on developing writing guidelines on the ISAs with regard to complexity, understandability, and scalability, and proportionality of the standard. And also it will directly inform the fraud and going concern activities that are going to take place in that work stream. Yeah, we can move to the next slide. As Tom alluded to, this is the final of a series of 3 roundtables. The first one was relating to fraud in the digital age. It was relating to the impact of technology advancements and the fraud perpetration and detection. The second one was around the expectation gap and trying to narrow the gap, exploring what the gap really is, and providing also feedback on the auditors' reporting standards. And then we have this roundtable, which will then focus on fraud and going concern in relation to audits of less complex entities. What we try to get from this is what's unique for less complex entities. What are the factors and the nature of frauds perpetrated that we need to identify in less complex entities, also including specific risk factors or identifying risk factors that are unique to LCEs. The same with going concern, but it's also then trying to look at which requirements in the ISAs are particularly challenging when it relates to less complex entities, both in relation to ISA 240 on fraud, but then on ISA 570 on going concern. We can move to the next slide. Thanks. As you all know, we have the discussion paper out. It was published in September 14th. The comments are due in January 12th. I encourage you all to provide input on that discussion paper. In addition to that, we have a series of other activities that were ongoing to provide feedback on this project. One of them being analysis and assessment of the comments that we received on other projects, which will relate to fraud and going concern. Then we're also providing a review of academic research and publication and outcome at jurisdictional levels. And we're having outreach and discussion with national standard setters. All these activities will help us and inform us on deciding on which activities that we'll do going forward. So if we move to the next slide. As I said, this roundtable discussion is relating to less complex entities. But what really is a less complex entity? It's a definition that is hard to come up with. In the work that we're doing on the developing audit standards for audits of less complex entities, we're working on this. We have no definition or description of that yet that are formal or decided. But I think for the discussion that we're having today, it might be good to follow the characteristics of a small entity that are defined in the ISAs today, that you have here: concentration of ownership and management, and also the other factors that are listed on this slide that are similar to the definition of smaller entities in the IAASB standards. So if you look at what we've heard so far in relation to fraud, these are aspects that we heard through many different activities that are issues that are regarding fraud procedures. One is the presumed risk of fraud in the revenue recognition. The requirement is not consistently applied in practice and may not be well understood. So they reduced the risk of the presumed risk of fraud in revenue recognition. Another one being the risk of management override of controls. That risk may also be reviewed inappropriately. Another one being that the standards are not unclear, so the extent of work required for journal entries for LCEs is not clear on what to do and the extent of work that are required. The last one is one we hear constantly lately, is that the language in the standards are complex, so it makes it difficult to apply the requirements on LCEs, but also on other entities. And the last one here is relating to going concern. The lack of formal forecast or the lack of management capacity or capability to perform assessments makes it sometimes difficult for the auditors to fulfill their responsibilities in accordance with the standards. So in a smaller entity where there's less formality and the management may or may not have the capacity or capability to perform the assessments, makes it difficult for the auditor sometimes. The next one is relating to the nature of the businesses. Sometimes the LCEs, they are dependent of, can we move one slide back? And dependent on their owners. So there's a while depends on that and the owner's willingness and their funds, so they will continue to invest. Sometimes they provide difficulties in providing evidence to support the assertions of the going concern assessment. And there's also been an ask for specific guidance on unique factors for LCEs to consider in relation to the going concern assertion. So the next one, I think this was an overview and introduction to what we heard so far and what we will discuss on this call. The next slide here, we will start on the roundtable discussion. For the discussion, we want you to use the raise hand functionality in Zoom. If you don't know where to find that, if you click on the participant list on your computer, on the bottom of the screen, you will see the raise hand icon on the participant list. So you can go in and raise your hand. If you're on a mobile device, there is a more button, and that will bring you to the raise hand functionality. So when we do the roundtable discussions now, please use the raise hand functionality to share your views. So if we start with the first question that are here, that are also in your paper, it's relating to the unique aspects of fraud in relation to LCEs. Is the nature of fraud perpetrated in LCEs different from frauds in more complex entities? And are there fraud risk factors that are unique or more prevalent in LCEs compared to other more complex entities? So if you can now start raising your hand, and the floor is open to receiving comments on the first question. We have a couple of hands raised here. If we start with Michael Sante.
Yeah, thanks, Kai, and thanks for the opportunity to participate in this important roundtable. I think from an LCE perspective, and I'll just give you kind of my background in U.S. standard setting has been focused on private companies, non-listeds, and so I think a lot of the LCE population that I think about is part of that non-listed population, and so I think there are certainly very different fraud risk factors that the auditor of a non-listed LCE might think about. I think there are differences with respect to the regulatory regime and reporting that occurs for those entities, the fraud deterrence that you think about that might be present for a listed company with respect to inspections and regulatory oversights and things like that. So I think the landscape starts as being different to start with respect to the LCEs. You know, you may or may not have whistleblower protections, those types of things. So I think that heightens some of the challenges for an LCE auditor. I think, you know, from the fraud risks that are listed, for example, in the current standard, and I know we're going to get to this, the entities that you think about with respect to revenue recognition frauds and those types of things are some of those listed in your consultation paper are fairly significant, you know, listed entities that have had issues. I think from an LCE perspective, areas of fraud risk that an LCE auditor might be more concerned about, for example, could be asset protection and embezzlement, either from inventory, from a cash, you know, follow the cash issues, things like that. So I think those fraud risk factors are important, and I think sometimes the LCE auditor may not be directed to look at those from a standards perspective. So I think this is an important aspect to think about as we move into this. I really support this project, and as it relates to LCEs, I think that you know, from where we get to you know, what recommendations on perhaps standard setting, this will be really critical from a you know, do we have a different set of standards applicable to LCEs because those fraud risks are different. So, thank you.
Thank you, Michael. Jenny Reed.
Thank you, and likewise to Michael, thank you for the opportunity to take part in this roundtable today. I would echo what Michael's comments. I think the frauds that tend to be perpetrated, certainly the ones that I've seen during my career, do tend to be different in the LCE sector. I agree there tends to be less instances of the sort of very sort of large scale revenue frauds that you might see in the listed company space, where the expectations of shareholders and, you know, large management bonuses and things aren't perhaps quite as relevant in a lot of LCEs. And I agree, you tend to see more asset frauds. If you do see fraudulent financial reporting, it tends to be trying to manipulate the amount of tax paid, maybe manipulate compliance with banking covenants, those types of things a little more. The other issue that I tend to find when thinking about fraud in LCEs is that some of the sort of traditional risk factors that auditors are taught to look for, like you know, staff working long hours, posting transactions outside of normal working hours, people being very protective of customer relationships. These are all hallmarks of normal business for many LCEs, and particularly the owner manager in those situations. And so some of the factors that as auditors we're often trained and conditioned to look for are not fraud indicators. They may be, but often it's just simply a factor of how those businesses operate. And so I think as auditors, we need to look quite differently at fraud in the context of an LCE audit.
Thank you for your input. Gordon Cummings.
Thank you, Kai, and good morning, everyone. Thanks for the opportunity to speak on this issue today. ISA 240 really kind of does, in my view, as sort of two focuses, I guess. It really focuses on fraud committed by an entity in the context of fraudulent financial reporting, and that certainly happens in my experience. I'm a practitioner, but the frauds that I've seen and experienced in my own practice have much more been frauds perpetrated against the entity. I think that does highlight some of the unique, what I see as unique issues with LCEs, and I certainly agree with what Jenny just said. We do have to approach an audit of an LCE differently, and you know, and in my firm we do. based on our experience with their unique aspects. I guess one of the main things that we look at and we focus on is a lot of the frauds are perpetrated by a bookkeeper or an internal accountant who's a highly trusted, often a long-term employee in a position of authority to commit a fraud really without being caught. Often, and you cited at the beginning of the presentations, that sort of quantum of small entities experience when they are defrauded. Often it's because these frauds go on for many, many years. That trusted person knows how to exploit the system, and they can steal, a small amount of money, but over and over again, month after month after month, often for years. And very often, I think something that's allows that to happen in an LCE is the owners are typically very knowledgeable. They have a high level of expertise in the business of the company, but they tend not to be that sophisticated in terms of business overall or finance or accounting. And so they end up placing an awful lot of reliance on that trusted accountant or bookkeeper, and often give them check signing authority and bank access and this without sort of compensating controls. Or the owner managers tend not to look at things like bank reconciliations and the basic protective controls that we as auditors would always suggest is appropriate for them to have. Very often too, and it's really kind of it's a bit heartbreaking in a way. A lot of the times when these frauds do come to light, the owners or the owner manager and the perpetrator, this trusted person, there's a strong friendship, there's a long-term relationship, and the owner just can't imagine that this could happen. There's a really significant violation of trust, and that just tends to get exploited.
Thank you, Gordon, and thank you all for your comments so far. We have a few more hands here raised, so we'll go to the next one. Atul Kumar Gupta.
Thanks for the opportunity. It was mute, sorry. While agreeing with the views shared by our few colleagues, that when we are talking about the less complex entities, there are that the fraud can be, as being rightly mentioned, that divided into the two parts, that to the less complex entity and by the less complex entity, because the management in all these least complex entities will be by and large in a proprietorship or a very small management is there. And even if you ask me, in the some of the countries, you will find that the management is practically a family-owned business. So a very, very important aspect which we need to highlight here, that when there is a family-owned enterprises, so there will be altogether the different set of business rules, and then the transactions will be moving in a different style. Another point which is very, very important, as being rightly mentioned by our just colleague here, Gordon, that when we have a person who is having the multiple responsibilities, as you have given in your paper as well, that in the small and medium enterprises, less complex entities, multiple roles are available to a single person. Now, what is happening that because of that, he is having the access to the customer or even to the supply chain. So in case there are being purchases are there and somebody is aware that, okay, so he is having the access to all these aspects. So there will be the more chances of the fraud. And I believe the standard rates for the products, unless and until are not available, the auditors will not be in a position to actually check the authenticity. So some kind of a guidance can be there that, okay, in case there is this kind of entity is there, then maybe some kind of a reference to the standard rates or the products can be there, in case that products qualify that particular set of characteristics for which the same is there. The another point is that when we are saying in the standard this 240 that we have to report to who's charged with the governance, and in the less complex entity, practically the time it may be the situation that actually they are committing the fraud rather than to whom. So finally, to whom I have to report, that kind of a situation will be there. And even in in some countries, reporting requirement is there in the particular Companies Act or a corporate law applicable, but above a threshold limit. So below a threshold limit, maybe a small quantum of the frauds are there which are not getting reported, because ultimately it is on the person itself who is charged with the governance. The another issue is that there is practically we have mentioned that the less internal controls. Actually, at times you will find that there is no internal audit and the internal control systems available in the less complex entities because of their nature per se. Even there may be the high volume, few transactions only. So everything is being managed by the few employees, maybe 10 employees, 15 employees. So there is no internal system, no internal control systems are there. The next important challenge which is coming with the less complex entities audit is that the adoption of the technology without having the controls available. So what is happening that, as rightly mentioned by Jenny, that the transactions are so it is not the case that transactions are posted in the evening hours or in the holiday. It may be the case that there are transactions are posted backdated because the systems are not having that kind of a control that should have been. So there may be so some kind of a system audit, some kind of a system checks should be the part of the entire process, because the vulnerability. So it is not by the management, even to the management also, that in case there the system checks are not there, so then there will be a problem with the audit assurance services. Then the language of the standards, which we discussed in our paper as well, that the language of the standard vis-a-vis at times we are discussing about the new standards. So whether we should create some new standard or it is the language. So my view will be that yes, because when you are doing the audit for the less complex entities, it will be the SMPs, and even the SMPs, you will say that even in the category of the SMPs also, you will find that they will be on a on a proprietorship kind of organizations which are doing the audit for the less complex entities, and they don't have that kind of a capacity to because they don't have the pooling of the resources. So in case we can provide that kind of a guidance in the standard itself, in case wherever there is a complex narrations and the words are being used. And finally, the different way of doing business, because now what is happening that because of the innovative way of doing business, startups are coming, valuations are happening. So even in a small, less complex entity, you will find that because of their unique style, there will be the valuations, there will be the strategic funding, and everything will be there. So in that case also, there will be, I will say, the evolution of the standard as per the requirement with it changing time is something which we need to acknowledge while reviewing the aspect. One last point which I wish to convey, that because of the all the roles are being there with the one person, or even maybe the management, the guy who is actually the ownership, having the ownership, and he's having the complete control over the transaction. At times you will find that in case the fraud is committed by the entity rather than to the entity. So it is in the case it is by the entity, there will be a challenge for having the trails of the evidences. So there will not be an absence of trails because entire transactions is being managed by the management itself because of their nature per se. So these are the views from my side. Thank you.
Thank you very much for those rich comments. And there are quite a few hands still up on this question, so we'll move on to the next one. Isabel, next.
Yes, hello everybody. I'm an IAASB member, but as most of my clients are less complex entity, I wanted just to quickly share some thoughts with you. My question was, is it because it's a less complex entity that we face less complex frauds? And I think the answer is not easy. Because on one hand, there is less separation of duty. So if there is less separation of duties, there are more opportunities to commit fraud, and then the fraud can be less complex. But on the other hand, as it's a less complex entity and a less complex business, it may be more difficult for the person that has committed fraud to hide it. So I believe that sometimes more efforts are put to hide the fraud, and then it becomes a more complex. So that was my point. Less complex entity does not necessarily mean, I think, less complex fraud. Thank you.
Thank you for sharing those views. Next one, Jill Spall.
I would agree with, well, practically everything. I'm sure everything that has already been said, particularly Jenny. Her comments were very insightful, I thought. Obviously, when we're talking about LCEs, we aren't entirely sure even what we mean, because we haven't fully defined what sorts of entity might fall within that umbrella. I don't think there's anything unique about the frauds that are perpetrated against and by LCEs. I think all the frauds that the mind can dream up that could happen in a smaller entity could also happen in a larger entity. But I think there are potentially, certainly at some ends of the scale, qualitative differences between the nature and circumstances of the entities, and therefore the frauds that occur in them or to them, than when in comparison with larger, not LCEs, so complex entities. I think in particular, because I don't really want to repeat what other people have said, but I think I'm probably going to. I think that in particular, the way that the kind of fraud triangle concept interacts with LCE organizations and people who work for them might have a slightly different emphasis. I think one of the things that you see more, or I suspect, I don't know for a fact, I'm not an academic, I haven't done any research, but the kind of the fraud, the sort of fraudulent financial reporting effectively that you do see in smaller organizations isn't just for tax avoidance, as Jenny mentioned. That is one of the things, but the other thing is the saving the business kind of fraud, people who justify to themselves what they're doing when they cook the books in order to keep their staff in work, in order to keep the business going, to tide them over the lean times, particularly at times like this when something really bad is happening. And they self-justify to themselves because they identify so very strongly with their company, which is probably their company that they may very well have started and are still running. And maybe they know every single one of their staff, and maybe they know all their kids. And so they justify to themselves what they're doing because they have such a strong sense of self-identity with the business, and they feel that what they're doing isn't wrong. Now, obviously, that absolutely can be a factor in fraud in a larger entity too, but maybe it's more remote. So that's one thing. I think Jenny's points about fraud risk indicators being different, that was a really excellent point, and I think that is something that could be looked at to help auditors, because there are all sorts of circumstances within LCEs that are different than larger entities. I would dispute the working all hours of the day, because I think everyone has to do that these days. But there are other things, the typical, if they do something really weird and you can't imagine why they did it like that, your skepticism, should spring into action. Smaller entities do things in a weird way. I mean, not weird to them, but maybe weird to the outsider, maybe weird to the auditor. That doesn't necessarily mean that they're intrinsically dodgy. It just means that they are quirky or individualistic. So I think we could usefully look at, examples of fraud risk indicators that are more appropriate to smaller entities. Might be one thing to do.
Thank you. The next one, Jane Schrader.
Hi, good day. Sorry, I had to switch off my video because our electricity has just gone out. It's one of the wonderful things about living in South Africa. So I've just quickly moved to a place where you'll be able to see me better. Thank you. I appreciate the comments made by Jenny and Jill as well. One of the things that Jenny said that really made me think I must maybe just add this one point is that when we talk about tax fraud, the one thing about LCEs or very specifically owner-managed businesses that I come across, I don't want to say often, but which I've come across more often than I wanted to, are those instances where the company is so closely related to the owner that it almost just becomes another part of the owner. So in terms of expenses or any benefits or anything that the owner wants or can get, they often put those through the business books because they're tax deductible, but it's actually got nothing to do with the business. It's actually the person, the individual's benefits. And so that I thought maybe just to expand on in terms of tax fraud, the fact to me that very often the person who's running that business or the family almost can't see the difference between themselves as individuals and the business, which leads to fraud from time to time.
Thank you. Still a few more hands up here. Ivan Kua.
Okay.
Hi.
Hello, everyone. Okay, thanks for this opportunity to share a bit more. Okay, having heard what everyone has said, I think I couldn't agree more. And based on our experience, what we have actually seen is that actually for less complex entities, misappropriation of assets by employees tends to be a bit more pronounced. And in the case of risk of fraud in revenue recognition, it is not so much, but in the cases that we have seen, it's actually an understatement of revenue rather than overstatement of revenue, because the typical setup is that it is a family-owned business. It's a very small outfit. There are a few employees inside. The owner is probably the manager that's running the entire thing as well. So the instances that we have come across is the incentive is for them to reduce their tax payment to tax authorities rather than to inflate revenue. Yeah. So, but having said that, it is also precisely why I said that misappropriation, as I said, is more pronounced, because if you look at the characteristics of the entity itself, because it's such a lean outfit, the employees are just a couple. The relationship between the owner and these employees tends to be a bit closer, which creates that opportunity that if the employees wants to defraud the company, it becomes easier. And coupled by the fact that there are not very strong controls, because it is to a certain extent, the environment is based on a trust system. So the cases that we have actually come across becomes a situation where employees actually steal cash, inventories, and so on and so forth. Okay, thank you.
Thank you. We still have a few more hands. Guy Cox.
Thank you for the opportunity. Most points that I wanted to tell you or share with you are already said, so I'm not going to repeat them. But in my point of view, it's very important that we start from the definition of an LCE, which means that you can start from, for example, less complex transaction or simple record keeping, which also reduces some risks which are now in ISA 240 very much highlighted. As already said, the revenue recognition, the typical management override of controls, therefore the procedures of the postings, journal entries during the weekend and the late evenings, in my experience, they are not really important for an LCE audit. They can be, but they are not as much as in a non-LCE audit. What I also have missed in the comments until this moment is that we see, we was talked about a fiscal risk or tax risk in a B2C context coupled on an LCE. In my experience, you have to be aware that there can be a risk for black money, because also the benefit goes directly to the manager owner. That's also something that you have to take into account when you're auditing an LCE.
Thank you. Nilesh, we come say.
Thanks, Kai, for the opportunity. Just to sort of give a different perspective to whatever has been said. See, one is the key differential is, I would say, ownership versus management. In case of LCE, the ownership and management is by and large within the same hands. I'm saying whether it's family, whether it is a small group of partners, etc. Whereas if it is other than an LCE, it is more complex entity. By and large, the ownership and management would be different. So that is one key, distinction. So here, the fraud by the ownership would be, say, if it's family run, only a few people in the family are running it. So that will be at the cost of some other family members they are doing a fraud. And in case of partnership, in say a couple of partners are managing on behalf of other partners, they could be doing a fraud. So that is vis-a-vis the ownership versus management, the type of fraud which can be there. The fraud by the entity, I would want to sort of summarize whatever has been said in two sort of categories. One is, in case I've got higher profits as a LCE and I want to avoid paying taxes, I want to pay lower taxes. So I would do whatever it takes to reduce the taxes. It could be by way of impact on revenue recognition, could be inflating expenses, could be some inventory, undervaluation or etc. That is lowering profit. Other aspect could be, as was said, is in case the entity is suffering some losses and because of its necessity to have continuing bank finances or prestige, ego, goodwill, or for the employee's sake or any reason, it could be for inflating the profits or reducing the losses. So in that case, it could be increase of revenue, could be reduction of expenses, and could be inventory inflation, could be anything. So this is the way I would want to sum it up in the type of the fraud which could be there vis-a-vis in the LC. One is ownership versus management. Here within the ownership there could be frauds, and second, in the case of fraud by the entity, depending on what position it is, if it has got more profits and pay lower taxes, it will reduce the profits, and in case it has got losses, it would want to increase the profits. So there could be frauds on that account. So this is the way I would sort of want to sum up the type of fraud which could be there in the LC. Thank you. Thank you for the opportunity.
Thank you. We have two more hands up, and then after that we will move to the next question, and we'll go to Twaha Kawasi.
Thank you very much for the opportunity to participate in the discussion. I think, to me and from my experience, what I see as unique and more prevalent in LOCEs is a situation of pressures where the owners are under any sort of pressure. You need to be on the guard. I had a colleague from South Africa who pointed out tax pressures, but there are others. For example, I've come across people with loans, obligations in banks, and they want to impress the financiers. So I'll sum up and say that this is really a function of pressures the owner faces. Otherwise, in the normal ways, the owner will not be stealing from himself, but it comes as a result of having pressures. If he has third parties involved in his business, and the third party claimants would normally be government for their taxes and also banks. That's my submission. Thank you.
Thank you. We'll then go to the last one for this question. Sean Villian.
Thank you very much, Kai, and thank you very much for the opportunity to partake in the roundtable discussion. Just an observation from my point of view, and just to give context, I work for a PO in South Africa, is with the less, those charts of governance, there's less levels within an LCE, and it's where the opportunity of an auditor actually has less opportunity to ask questions, because if you have more people that's within an organization, you can get a better understanding by asking probing questions. So if you do only have fewer levels to ask those probing questions as an auditor, you need to be extending your audit procedures to get a better understanding of the entity. And I think it was echoed also in the fact that referring to the weird way of doing business of LCEs. And it's literally, as an auditor, you need to get a better understanding of that LCE's environment, the industry, and why they're acting in a certain way, and to become more aware of possible fraudulent activities. Because where management is seen as one and where there's no differentiation between the business and the management, it really becomes, or the owner privately, it becomes very difficult to detect these fraudulent activities. And as auditor, you need to be really putting the right hat on and asking the right questions. So that is just something that I kind of wanted to share. Thank you.
Thank you. And this is clearly an area where you have lots of insights. So all the comments you have not been able to raise now, please feel free to send them in your response to the discussion paper as well. So this was about the nature of the frauds perpetrated and the fraud risk factors. And we can now move on to some of the fraud procedures in audits of LCs. So if we go to the next slide, we have another question, which relates to some of the challenges that we heard that we've been highlighted to us so far, that we listed up earlier as well. And we want to get some information from you if you feel these are challenges that are unique to LCs and why they're challenging in audits of LCs, and if there are any specific areas of the standards where the language is complex and makes it then difficult to apply in audits of LCs. And if there are other areas of ISO 240 that are challenging to apply and why. So it's a wide range of questions relating to the procedures of audits in LCEs. So the floor is open to you to provide comments. Jill Spall?
Yeah, I don't think that any of those challenges are unique to the audits of LCEs. I think that, you know, the impact might be different between an LCE audit and an audit of a complex entity. But I think that, you know, personally, I think the rebuttable presumption is great. And I've seen many auditors who are absolutely fine with the whole concept, whether they're auditing an LCE or a more complex entity. And frankly, I've seen some auditors who are not fine with the concept, whether or not, you know, whoever they're auditing. So yeah, management override, I think, is a particular risk in an LCE, particularly an owner-managed entity. But it's not like it's not a risk in a complex entity. And again, I've seen people rebut, which you're not supposed to be able to do, the risk of management override in audits of, you know, all sizes. So again, I don't think that's a unique problem for the audits of LCEs. Journal entry testing, I think that is a problem across the board, not just in LCEs, or it's not a problem. If people know what they're doing, then they know what they're doing and they do it just fine. If they don't know what they're doing, then that's an issue. And again, the language in the standard, it is complex, but I think that people for whom the language is complex, they will feel that it's complex again in audits of any size. I think the requirements of 240 are in some cases quite detailed, and you could probably skip some steps in the audit of a less complex entity. I think there are probably different steps or different considerations that are currently missed in 240 that would be more relevant to LCEs, but that's not the same as saying that it's just the language is complex if you're auditing an LCE, but it's just fine if you're auditing a more complex. I think that, to be honest, I have a problem with the whole idea of uniqueness. I think that you know, nature and circumstances differ, and we need to consider that, and we need to be really very sensitive to that. But saying that there's some types of issues that only ever occur in LCEs, I think is approaching it from the wrong angle. I think there are things that don't happen in LCEs, but I think that the vast majority of things that happen in LCEs could also happen in more complex entities, and similarly between the audits of LCEs and the audits of larger companies.
Thank you. Next, Michael Sante.
Thanks, Kai, and really good points to start this off, Joe. I think the challenge, you know, I think the starting point is, do we have an appropriate, you know, framework for the standard? You know, when we were talking earlier about the fraud triangle, you know, the brainstorming sessions, those types of things. I think they can be very effective and have been. And so I think, you know, as from a starting perspective, from an LCE or from a, you know, you kind of start to blend in, you know, are we trying to create a separate standard? Is there overlap, things that are important for both? And I think the starting point with what was developed, you know, 20 years ago with the fraud standard is, I think, still holds true today. And I think, you know, it'll be important to see what other research you guys can find on this, but I think that the starting point's important. You know, I think the heart of the discussion here on the procedures is, do we need a required bar? Do we want to set a bar as it relates to the minimum procedures you're going to do? You know, the requirements that were set up, as I said, 20 years ago, were driven mostly by studies of public company frauds. And so that's what we ended up with here. We've got revenue, we've got management override, testing journal entries, because that's how the frauds were done. And so still all very important today, but I think when we combine that with the fraud risk factor discussion we've had, does this, you know, do we have a bar that's going to push people down a path, you know, and it's going to kind of take their eye off where the other fraud risk factors could be? I mean, I think you start with the brainstorming, then you have these minimum procedures that you need to do in these areas. So is it too, you know, for an LCE, are we directing the auditor to look in the right areas, or are we kind of forcing them into these paths of, you know, how can I test the journal entries most effectively? Do I really need to test revenue here? Is that a concern? Or do we want to open this up a little bit more for the auditor to decide? You know, have the brainstorming and then say, okay, where do you think you're going to have your fraud risks? And I would be a little concerned that would be too open. That we would, you know, that without some bar, without some minimum procedures that need to occur, we would lose. You know, we might end up with less work on fraud than might be appropriate for a circumstance. So I think there are challenges with setting a bar, but I think it's important. Are these the right areas to focus in on? I think it's a good starting point, but as based on the fraud risk discussion, I think we need to rethink that. I know the paper talks about bringing in forensic folks. I thought about that when Gordon was talking earlier about, you know, the first person that forensic folks going to be concerned about is that trusted employee, Gordon, you were referring to. So I think that's a good perspective to have. And so I think the use of a forensic person on an LCE, balancing that cost benefit that the paper asks us to think about, could be challenging, but certainly a tool that could be used, and so, or at least a mindset that could help the LCE auditor think about where those frauds could occur in that brainstorming. So do we need, you know, I think the procedures are fairly straightforward. What people do with them have been challenging, as Jill said, and I'll stop and let others talk, but I think there's a lot more to talk about with respect to where we want to direct the auditor from a fraud risk perspective, and the interaction with the going concern risks that I believe was talked about earlier. You know, what is a driver? You know, how do these standards interact from a risk perspective? So it's great we're dealing with these together. So thank you for that.
Thank you. And then moving on to Gordon Cummings.
Thanks, Guy. In my experience, the presumed risk of fraud in revenue recognition, I think it's in the standard because of Enron. I think the management override and the journal entry testing is there because of WorldCom, and I'm just labeling it that way because, you know, these are historical, very, very significant frauds. I'll come back to that point. The rebuttal issue with revenue, I don't find in practice to be problematic. I think it's difficult to do, I think, when applied properly, and I think that that's appropriate. So I think practically it doesn't present an issue, and it often leads to some really interesting conversations. I'm not sure that, again, this is a type of fraud that would be committed by the entity to overstate often its revenue. Not probably the top type of fraud that I would be concerned about doing an audit of an LCE, but I think we've learned to cope with this in practice and can do so reasonably well. The risk, and it was said earlier, the risk of management override is often inappropriately rebutted. I didn't know you could do that. I don't think you can. There's an explanatory paragraph, if memory serves me, in ISO 240 that says something along the lines of management's in a unique position to override controls that otherwise appear to be operating effectively. I mean, I think one of the practical problems that I think a lot of us have in practice is, can somebody override a control that isn't designed properly or implemented effectively? So, and I think you can't. So in practice, we're doing journal entry testing specifically, as because it's required, looking for an override of controls where someone wants to commit a fraud with journal entries. They don't have to override anything, they can just do it. So the premise of doing the testing kind of falls apart, and we end up in disputes and fights with file inspectors and regulators, because they look at the standard and they see that it prescribes a very particular process an auditor has to follow. In particular, that an auditor has performed that process exactly as specified, and different regulators have slightly different views about what that means. My experience is they're really not that open to other ways of achieving the same objective. And the types of audits that I do, I can print out the general ledger and scan through it in about a few minutes, or I can look at all of the journal entries posted for the entire year with my eyeball. I don't need a data analytic tool. And most of the time we will have performed procedures in other aspects of the audit on those major transactions. And one would like to think that we could argue that, look, we've looked at all these transactions through other procedures that we've done. We don't need to come back and sort of re-perform different procedures, and that's been found to be not acceptable. So I think we end up doing an awful lot of work to document the performance of these procedures. That's really, and I don't mean to be cynical, but it's become a bit of a performative experience. I don't think I've ever actually found a fraud or anything that really sniffed of a fraud through doing journal entry testing. So I do question the premise of it. I think there are times where it's obviously in the standards for a reason. It did come from a real world fraud. And so it's there for a reason. I think it does need to be performed in the right circumstances. Just not sure it's the right tool in all circumstances. And just to pick up something from the last section, I think is still relevant here. Something that we as auditors need to be conscious of and aware of in an LCE audit is we often end up inside an echo chamber where we are primarily dealing with the person within the entity who's most likely to be committing the fraud. And so we can end up sort of doing procedures on a Potemkin village of documents and questions and interviews where we can never sort of get behind the camouflage that's been built for us. And so I think there are other skills that auditors may need to develop in the LCE space, things like interview skills, being sensitive to how people respond to questions, that sort of thing that I found to be very effective in my practice. So I think there are some slightly different skills and approaches that LCE auditors may be, I think, well armed with to give them a better sense of just being a little more sensitive. It's kind of that EQ thing. It is more of dealing with individuals And because we're at the level where we're not dealing with institutions with lots and lots of people, we can talk to the individual. Often we are talking to the individual who's doing this, and they do tend to telegraph, unless they're very, very skilled at deception. They do tend to be sort of telltale signs that we can pick up on if we're if we're sensitive to it and really trained to do it. So I'll stop there. Thank you very much.
Thank you, Gord. We'll take a few more hands on this question so that we can move on to the last one before the break. So next one is Sarah Colson.
Just as mentioned, often management's concerned with minimizing tax rather than maximizing revenue, and therefore, I have seen revenue appropriately rebutted. What I find is hesitation, why often they're looking for rebutting. The motivation comes from the rebuttal of the fraud risk is the avoidance of testing the controls, which being a less complex entity, the auditor's already expecting to fail that there aren't formalized controls. And so because fraud risks are automatically significant risks and significant risks require the understanding of controls, the possibility of testing those controls if the substantive procedures aren't alone sufficient. And some methodologies actually assume that for significant risks, you must test those controls. And they're just not the sophisticated systems. There's not the formalized controls. There's limited segregation of duties. It's just sort of, management override could be part of the normal course because there is only one person recording the entries and it's management directing that person to record journal entries. Also, the standard refers to management's process for identifying and responding to the risk of fraud. So talking to management, writing down what is their process. And it's difficult often because it's not a formalized process. The only time that, an owner manager may think about it is when the auditor asks the question. And then it's, a response just to get the auditor to go away. Is it good business sense that they have those procedures in place? Yes. And especially since we've talked about usually in less complex entities, it's the misappropriation of assets and then the hiding of the misappropriation of assets by a trusted employee that is manipulating the financial reporting. And then, as mentioned before, the less complex entities have simple structures. They have simple accounting packages off the shelf with no approval mechanism. So when looking at journal entry testing, was the journal entry approved? Well, the packages that these small entities use don't have that approval process in place. I've gone to boards of directors and management to say to them, so, okay, we understand your system doesn't do that. How about, monthly or quarterly when you're reviewing the financial statements, you also review the printed journal entries and sign off to show that you have read it. So it's not approving it before it gets posted to the system, but there is a point in time of approving it. And raise it with the board, and it's just sort of like, okay, fine, but that's not practical for us to do. Once again, trusted employee, they're the finance people, they know what they're doing, and that's not worth my time. I'd rather grow my business and make those business contacts than spending the time reviewing journal entries.
Thank you. We'll take one more hand on this question before moving on to the next one. I don't want to stop the discussion, but so that we have time to go through the rest, and then we might come back if we have more time. Hilda Blomma.
Thank you, Kai. Good afternoon to all. I am speaking from the point of view of a project that within Accountants Europe we are doing actually on fraud and also going concern. It's much wider than standards, but it's on the same subject matters. One could wonder why. And it's picking up on the last bullet point on the slide related to auditors' responsibilities and language, and then how this actually links to ISA 700 and the reporting of the auditor. And if we go there, it basically says, well, that the objective of the audit is to issue an opinion and to give assurance, reasonable assurance on whether the financial statements as a whole are free from material misstatement, whether due to fraud or error. And when we then go back to ISA 240, it was very much put to us that the responsibilities, the language around the real responsibilities of an auditor on fraud are not really as clear as they could be. And it's especially related to having this more, well, skeptical or even suspicious mindset, and also to be more upfront as an auditor, thinking about the possibility of fraud within the company or its reporting, actually down from the client acceptance or the client continuance process, because it is considered that in the audit report, we put fraud and error on the same level. But if you look normally how you do an audit or how much time you spend much more time on the error part than on the fraud part. So that's where this appreciation or this thought came from, that maybe the responsibilities are not clear and could be clearer, and what they really should be for the auditor. If we then put that in a LCE context, the readers of the audit report might not be as sophisticated as they are for larger entities, and they might genuinely expect that the auditor has the responsibility to detect and to report on every fraud, not knowing about inherent limitations of an audit or the materiality that comes into an audit. And we consider that might need to be specifically addressed in the work you're doing. Thank you.
So we can move to the next slide. If you still have comments you want to make through, as I said earlier, make sure that you include them in the response to the discussion paper they're out. So the last question we will have on relating to fraud is then relating to the users of the financial statements of LCEs are often different than the users of the financial statements of more complex entities. And are there any specific procedure or necessary procedures that you as the auditors should consider in relation to fraud of LCEs that the user's financial statements think that you need to do? So views on if the user of the financial statements have any specific or necessary procedures that they consider you should perform.
I mean, I think this is the expectation gap. Certainly my own experience is there's an expectation that if there is a fraud and if it's material to the entity, we would have found it. And so what does that specifically mean? I'm not sure. What is a lot of the frauds that I've seen in practice are, and I think Isabel said it earlier very well, very sophisticated and not easy to find. And we're often dealing with the person who's committed the fraud and knows, they're pretty sophisticated people. They're often accountants, they're often trained professional accountants, and they've obfuscated the evidence, or they're withholding the documents that we would want to see that might highlight the issue. In a few cases in my firm, we've participated, and we don't do this practice generally, but we've participated with forensic accountants in investigations where a professional forensic accountant has sort of concluded, well, we think there was probably a fraud, but we can't figure out how it was done. And despite access to all the records, so records can be destroyed and are hidden. And so what does that mean practically? I think it means we've got a challenge on our hands.
Thank you, Gordon. Michael?
Yeah, just picking up on what Gordon said, I think when we think about the expectation gap, the procedures, maybe it's not so much the procedures as it is the areas that we need to focus on. And this kind of goes to our fraud risk indicator discussion earlier. Is the stakeholders may be different for an LCE. It could be, depending on how we define it, that it's a pension plan, or it's an investment, a small investment fund that's private. That the stakeholders, what do they expect you to do? Where are the areas of potential fraud as it relates to protecting their interests or their assets, or what where a fraud could occur that's going to impact them. And so I think that's the context perhaps of the the fraud risk, when the auditor of an LCE is thinking about, where are the stakeholders most concerned, and it's typically aligns with the misstatement risk, as someone was just saying, but sometimes we might audit it a little differently if we think, if we're thinking about it through a fraud lens, and so that's the point I wanted to make.
Thank you, Jenny.
Hi, I think it's actually it can be quite dangerous to try and generalize amongst LCEs, because there is such a wide variety of different entities that potentially could fall under that description. Gordon's just mentioned some like small pension schemes, but often actually it's really just a matter of scale, because in a pension scheme you may have 12 members and they're all interested in the safeguarding of their assets for their pensions, but that's no different in a large scheme with several thousand members. There may be more of them interested in the financial statements, but they still have the same interests. And I think the same is true with owners, with funders, banks, etc. They're all going to be looking fundamentally for the same things, and often with an LCE it's simply a matter of scale of how many such parties there are, rather than the fact that they're fundamentally different to those who are interested and users of the financial statements in larger, more complex entities. So I think trying to say what would those parties expect us to do as auditors from fraud procedures, I think it's very difficult to generalize from the perspective of users, because there are so many different types, and I don't think that is different or unique to LCEs. And of course LCEs themselves are also different. There's an enormous breadth of different types of entity within that category. So trying to specify very specific procedures is difficult. I mean, we've already spoken at length about the issues with revenue and how that can be different. But some of the sorts of entities that we might consider under this banner might be small charitable entities, in which case, revenue recognition may be a very different issue. And so specifying procedures is always going to be difficult with that amount of variety.
Thank you, and thank you all for providing such good input and insightful comments relating to fraud in LCEs. Thank you for all the comments before the break, and that you're now reconnected after the break. In the second part of the discussion, we will move on to going concern procedures in audits of less complex entities. And the first question that we have on this slide is relating to unique aspects, going concerns in audits of less complex entities. And are there characteristics that are unique when auditing going concern assessment for LCE compared to more complex entities?
Hi, I'll make the obvious point as we're kicking off. Frequently the lack of formal information to look at from going concern. In many smaller and LCE entities, you don't tend to get the formal cash flow forecasts, extended detailed budgets. Maybe you get profit and loss but not balance sheet, or if you do get that information, it's very limited in its scope. So not everything perhaps is factored in as much detail as it would in a more complex entity. And there's often more reliance on the knowledge of in relevant LCs and owner manager in knowing how the business is doing and whether it's faring well, rather than on formal information, which is always going to be an issue. The other thing I think that also contributes more to certain LCEs is the sort of irregularity in which many LCEs operate. So you don't get the sort of set things like dividend policies that you would in large complex entities and listed entities. Money will be extracted out of the business on an as and when we can afford it, do it basis, which may be very irregular, more discretionary. And so there'll be certain things where, you won't see those sort of nice regular patterns that you might in a more complex, larger entity. You may also see lower levels of working capital. So the margins on which the business may be operating may be thinner.
Thank you. Next, we can move on to Gordon Cummings.
Thanks, Kai. I agree with Jenny's comments, and I would add, and I think this is particular to privately owned businesses and just maybe a subset of LCEs. Often they're really they're kind of I'll use the term special purpose entity of the owner manager, of the founder, or of the family. You know, when you think about a public company, it is an institution unto itself, and it has owners and it has managers. But when you go into private business, the owner, the founder, or the family, you know, if it's an older company, often has interests outside of the entity that we're engaged to audit that are relevant to a going concern assessment. So if the entity has significant bank debt, there will be security posted outside the entity itself. There'll be family assets, home, you know, vacation properties, other business interests. There'll be other companies in the corporate group. Often, a lot of this is tax driven. So we may have, to use the terms of art in the profession, you know, an opco or a series of opcos. We might have holding companies or maybe family trusts kind of scattered around. And to do a going concern assessment of just sort of one slice of that can be difficult, because we don't typically do an audit of the family or the individual founder. So we don't necessarily know what their assets or their debts are. So it's hard to take those things into account, where it seems that we have to in some circumstances. And I think, to reinforce Jenny's point, it is certainly the case that many transactions that a private company will enter into are actually really transactions of the owner, manager, the shareholder, the founder, driven by things that are happening in other businesses that they own, or other investments they want to make. They want to build a new house, so they start to pull out lots of cash. And they may even lever corporate owned assets to create cash in the company that they'll take out as a loan or as a dividend. So really, you know, different in the sense that if you approach this from the perspective of auditing a public company, these entities do very odd and unusual things, and that's the routine, that is the norm. And so taking that into account, trying to apply the tools that you would use for a large public company to this part of the market, it breaks down.
Thank you, Gordon. Moving on to Ivan Kua.
Okay, thanks, Kai. Okay, I think the characteristics that are unique when auditing going concern assessment for LCE that we have observed is that for some family-owned businesses, as well as the smaller ones, because they don't have very formal processes, and they don't have very structured process, and sometimes doing forecasts is actually a challenge for them, especially when it comes to going concern assessment, because exactly like what Jenny has said and Gordon has said, so in certain situations you're only given a profit and loss account, and that's about it. And as a result of that, it invariably entails a lot of hand holdings by the auditors in terms of to guide them in terms of doing this assessment and so on and so forth. And I think the other unique characteristics of looking at the going concern assessment for less complex entities is that invariably the use of letters of financial support. Sometimes from the entity's perspective, it is clear that there are going concern indicators, but the founder owner itself is saying that, oh, I would support it. Yeah, so it is a bit challenging, exactly like what Gordon said, because we don't audit the individual itself. So it's a bit challenging to find out or to understand a bit more. Does he really have the ability to really support the business, so to speak? Yeah. So this is where this set of characteristics in itself makes it a bit unique and a bit challenging. Yeah. Thank you.
Thank you, Joanne Schreiber.
Thanks. I think what the previous speaker had just said is that when the owner of the business says that they will support it, it's often, well, it's obviously risky, but it's so difficult to then actually go and almost sometimes it feels to me like you're almost insulting the person by saying, okay, prove to me that you have the ability and the willingness and the intent to actually support the business when it comes to it. So if I have a subordination agreement or anything like that, how can I trust you that you're really going to give it to me or to this business when it comes to it? The other thing, of course, also is where this less complex entity may perhaps be in a group, almost like one of the previous speakers said about all these different entities that all form this network. Then often the entity that is providing the support will have given you the letter or signed something, but you can't actually access any more information from them if you're not the auditor yourself. Whereas if you're auditing a whole group, a holding company and all of that included, then at least you can see everything and you can maybe get the official letter from the bank. But if it is an individual or an auditor, or rather an entity that you are not auditing yourself, then very often it's almost like your hands are tied because you can't really get the information without people often basically almost feeling insulted by the questions that you are asking. Maybe coming back to how do we ask these questions, how do we ask for this information? But very often also, especially thinking about going concern, very often these things are, even though we've been starting right from the start of the audit, when these things really get to the end of the audit and now we need the letters of the subordination agreement and the support and the whatnots, then there's pressure from the banks because the bank wanted the financials yesterday or last week or whenever. They need the financials for the overdraft to be approved, whatever the case may be. And then often there is not that time to patiently go through and ask the questions and get the information to be able to really make a proper assessment. And I think that sometimes we make a rushed assessment in that case as auditors and say, okay, just give me what you can and I'll document some kind of story to pretend it's good enough. Worst case scenario, but that's not really where we want to be as auditors. We'd rather want to be in a position where we've got enough time and enough documentation to really objectively assess whether this really is going to be a going concern. Yeah, but because we can't always get the information or get the information and maintain the relationship, that becomes difficult.
Thank you, Michael, Sante.
I always like the comments about time that you just made, Ron. It's could we have more time? We need that stopwatch where we can stop time for a while and do the work we need to do and then start the stopwatch again. Just real quick comment that, LCE focus on owner managers and what we've seen a trend in the U.S. is an expansion into private company financing, smaller, and it may meet the LCE view. It's more private company, opportunities because less companies are taking advantage of the public market, and so this has been a concerning trend, but it's also something that continues to grow. So, when we have, and this is taken, the SEC, the Securities Exchange Commission in the U.S. has taken notice of this and has actually had, looked into some private companies from a disclosure perspective, from a fraud perspective, things they've done to mask a going concern issue. And so I think how we audit might be different in an LCE that might be expanding beyond the money that they're getting from a bank who, we kind of assume, okay, there's a bank involved, so they know they got the inside story on things, or, people are connected. I don't need to focus on the disclosures as much, to Jenny's point. In a private company, we don't have as much. There's no the regular reporting that goes on. But are the disclosures sufficient for some of these newer investors that an LCE might be taking advantage of? And I think that might be a different perspective for an auditor going forward. And as the owner managers might look for alternative sources of financing, and are the statements true and fair? Is there a fair presentation with respect to potential liquidity issues that might not be a required disclosure in the framework, the accounting framework, but the auditor might think, boy, I really think we need to get this in there based on the users that might not have this information. So that might be a shift in how we think about LCE disclosures and going concern risks.
Thank you, Michael. Atul Gupta.
Thank you for the opportunity. And actually, the point which I wish to convey, just Michael mentioned, is about the going concern. that there are the few aspects which I just sharing that when we are talking about the less complex entities, you will agree with me that they all are practically the individual skill-based industries. So somebody is maybe doing, for example, somebody is doing an architecture job, somebody is having a special skills available, or based on his personal experience, maybe the family owned. So there will be always a challenge of the going concern, because the moment he is not there, and the skill set which is required to run an organization will not be there, and there will be a challenge. So as an auditor, whether how I will be able to assure myself that okay, there will be a going concern, because if the owner is not there, specifically in a case of a proprietorship concern or a special skill based organization is concerned, that will be there. The another aspect which we may discuss and times to come, that whether it is a service becoming product. So in case there are the organizations where there is a less of a dependency on the special skill sets, like a small manufacturing company is there, and they have already the productization of the things, or even the services become product, then there will be the different altogether the ball games that okay, that can be there. The one point which I was discussing when the Michael just mentioned is about the going concern specifically. So is a funding which will come from the owner or not is something different. But what we need to assure specifically a point which is very important is the going concern towards the creditors and the other guys from whom I have taken the money. So that is something very, very important that we need to give a special emphasis in the less complex entities, that the auditor need to give a kind of a doubly check that at least up to that level the going concern should be there, that can meet the liability in case of any eventuality. Maybe, for example, unfortunately the owner is no more available with the organization, but at least the organization have that much of a capacity available. Maybe the somebody, for example, just to share with you the insolvency. Now, if somebody is moving into the insolvency side because of the one or the other reason, then at least the debtors are available or the assets are available to at least meet out the situation of a liability towards the various stakeholders, including the creditors. So this is something we can deliberate upon.
Thank you. I think we then can move on to the next question. The next question is relating to going concern procedures. And on the slide here are listed some of the challenges that have been highlighted to us so far. Some of them are similar to what you already highlighted on the previous question: lack of formality, survival dependence on the owners, and need for guidance. So the questions we have for you here is, in what area is additional guidance needed that would be unique to the auditor's procedures in an audit of an LCE? And if there are any other requirements in ISA 570 going concern that are particularly challenging to apply for audits of LCEs, and why? So comments on the going concern procedures. First out, Guy Cox.
In my experience, management assessment of going concern is often not available, or certainly not explicitly documented. It was already said. And for that, I think it's important that you shift also the focus for an LCE on the application of identification risk events, because when is the moment that it really goes wrong? That is when there are some going concern risks that occur suddenly, and yeah, perhaps spending less time or asking less time from the management in their assessment, which is often very difficult, but discussing with them which risk events could occur, and yeah, it can be very insightful, I guess, and it can really help a practitioner in going concern procedures.
Thank you. Joanne Schroeder.
I just want to just highlight one point, and the standard also refers to it about subordination agreements. But something that I've found practically, which people forget to think about, is that it's one thing to get in a subordination agreement for this year, to say, right, so the guys are signing this year, they're subordinating their loans or whatever the case may be. But the auditors need to remember to think about what happened in the previous year. And I suppose it's also very carefully or very clearly coming out in the revised ISA 540, where the auditor is actually told to go and look at what happened in the previous year. And I'd actually like to see something like that coming into 240 to say, but also look at what the plans were in the previous year and whether management actually had done what they said they were going to do. So if you had signed your subordination agreement last year and said the owner will not be taking any funds from the money owed to him in order to support the creditors or until the company is in a net asset position again, well, then go and have a look whether the owner did actually take any money from the business. Because often you'll find that the owner did take money from the business. Yes, the company didn't go under, but he actually didn't stick to or act in accordance with that subordination agreement that he signed for last year's audit. And that then makes me very mistrusting as to whether he's actually going to stick to what he's signing for this year. I personally wouldn't trust the paper that he puts it on or trust his commitment in that regard.
Thank you. Sarah Colson.
As already mentioned, the lack of formal assessment makes, the accessibility or assessing the feasibility of management's plan difficult because management's often unable to perform like a very detailed assessment. What I've seen is, the auditors are spending significant amount of time to prepare their own detailed assessment on the going concern to compare to management's, just saying, oh, it'll be fine, everything's going to be fine. And maybe a weaker forecast or an incomplete forecast. Also, being a less complex entity, often in the private space, it's access to comparable information. How do you assess the assumptions? You can go to public information, but public have different pressures and different factors that are affecting it. So trying to assess the reasonability of the assessments in order to tie back to the feasibility of going concern is an issue. And then also raises, it's often a whole lot of reliance on that representation letter or, the documentation from the owner that they will be providing funds and continued support for this business.
Thank you. Nilesh.
Thank you, Kai. I think all of us discussed the challenge in implementing this particular standard for less complex entities, by way of the management is able to assess the future, the forecasting is not able to do, and also the enough audit evidence they are not able to provide to the auditors to look at from the going concern perspective. So just a loud thinking, can we, and the idea of this whole exercise is how do we simplify the standard vis-a-vis the less complex entity. So maybe it may look like a radical idea, but say in a general circumstances, can we red flag the users of the financial statement, saying that the going concern analysis, because of the following reason, it is say the the ownership structure, the continuity, the way the structure is, has not been assessed properly, just a generic in the audit report or in the financial statements. And unless it is very clear that the going concern has been impacted, for example, the pandemic, some businesses may go out of business in this COVID pandemic. So can we, give a responsibility to the auditor saying that if it is absolutely, based on his assessment that the going concern will be impacted, then he needs to report that the going concern is not there. Other than that, we just give a sort of a disclaimer saying that this aspect has not been examined in a normal circumstance because of the way the structure of the less complex entities is, the ownership, the continuity, etc., etc. So tomorrow the owner may just may expire and there is no continuity plan, etc. There's no succession planning, etc., etc. So based on the risk which are there as far as implementation of this particular standard to less complex entity, can we have a general disclaimer for normal purposes? And unless the situation is absolutely warranted, where it's very stark based on the financial statement, it's not going to be a going concern. At that point of time, the auditor should say it's not a going concern. Just a loud thinking on the approach.
Thank you, English, and thanks for sharing your comments. I think we have one more here, Jenny Reed.
Yeah, I just wanted to comment on that on the bullet point there about the challenges in ISO 570 of auditing going concern in LCEs. I think the one thing that in my experience often is the most difficult, and I know a number of auditors have the same problem, is we've all spoken how it's often that LCEs don't provide formal information for the auditor to do going concern. And in that situation, ISO 570 requires us as auditor to ask for that information. And we know perfectly well that the client hasn't prepared it. And in most cases, even if you ask for it, the answer is still going to be no. No, I'm not going to prepare, a 12-month rolling cash flow forecast for you. And the fact that the ISA requires you to ask the client, and I totally understand why that requirement's in the ISA, but it can start to put a wedge between the auditor and the owner, because there's very little point in many cases asking for something the owner is not going to give you, and the owner then gets annoyed that you're asking for something that they're not going to give, and that they're not going to give, and it starts putting that wedge between the auditor and management, which is not helpful, given that so much of assessing going concern requires you to talk to the owner and understand the business and understand where they're taking it and what their plans are and their intentions, etc. So I'm not arguing that you should necessarily take that requirement out of the ISA, because I totally understand why it's there, but it's just to be aware that it can cause real problems in LCEs where that formal information isn't prepared as a matter of course.
Thank you, Jenny. Do we have any other comments in relation to specific guidance needed, or any requirements in ISO 570 that are particularly challenging? If there are no other hands, we can move on to the next question. The next question is somewhat related to some of the comments that came just on the previous question here, and as with the fraud, the users of the financial statements of LCs are sometimes different. And what do you think are the users of the financial statements of LCs view as necessary procedures when considering management's assessment of going concern in an audit of an LC? So what are the views of the users of financial statements and procedures that they think you should perform? Michael?
I'm kind of thinking about this one, not so much in the procedures aspect, but in the disclosure and the reporting. And I know we've just had the auditor's report project, and I know there's post-implementation review around going concern, other aspects of the changes to the report. One of the discussions we've had from a U.S. perspective is the use of emphasis or critical audit matters in the U.S. for public companies, and the U.S. has adopted the key audit matters reporting. And the question around when do you call out a liquidity issue, a material uncertainty, and perhaps an emphasis paragraph has always been challenging, because I think it gets misunderstood. And that kind of plays into the whole, and I think this has come up in some of the previous roundtables, and I think it's in the paper about the self-fulfilling prophecy. If I put a going concern, substantial doubt paragraph in, then I'm gonna, some vendors will see that the poor LCE will go to cash, will make a problem much worse, and kind of a death sentence for them. So I think we hesitate as auditors to add the going concern paragraph has always been challenging. Even more challenging would be an emphasis paragraph that says they have issues, right? We wanted to highlight some of the material uncertainties that they're dealing with in their revenue, sustaining revenues and cash flows, or other areas that might be meaningful to a user, but if I put it in my opinion as an emphasis, it's going to be misread as saying, "Oh my gosh, it's a going concern," and so and it'll be treated the same. When the U.S. adopted a revised standard recently, we added a application guidance to consider those. I think as it relates to these types of circumstances to call out material uncertainties, and that's I think what they're there for. But I think it's an area that as an auditor, and what more could we do? What more is expected from the users not so much in the procedures, but in the disclosures, that's probably an area we can continue to look at, because I think this can be useful to call out, enhance the usability of the report for users in this area. But it's a tricky one, especially for an LCE. So I don't have answers, but I think it's worth exploring, and I think the users would have a view that those procedures / disclosures would be beneficial. Thanks.
Thank you. I don't see any other hands right now, but and if you have any input on what you think the users of financial statement would view as necessary procedures, please share them now, or you can include them also in your response to the discussion papers. But if there are no other input, we can move on to the next question. This one relates to the practical application of both ISA 570 and 240. And the procedures that you're performing in relation to going concern and fraud is different, and the procedures many times different than the procedures that you're doing in more complex areas. Or are they different? And if they are different, what are the differences when you're performing the procedures? So are the procedures that you perform in practice different for less complex and more complex entities? If they are, how are they and what are the differences? Gordon is kicking us off.
I mean, I don't feel well equipped to answer to this question, in that I don't think in my practice I deal with complex entities. I pretty much only deal with less complex entities, so it's a little bit hard for me to contrast. I guess what I don't mind sharing is that I find in my practice that there's a bit of a disconnect between kind of reading the standard, knowing the background to why certain requirements are there, versus sort of how to practically apply them. And for example, I'll go back to the journal entry testing. It's there for particular reasons, because of historical events, and it's targeting specific things that have occurred. It's generalized fairly, but it's written in such a way that it doesn't sort of lend itself, as we discussed in that section. It doesn't lend itself too well to the world that I live in kind of practically. So, we kind of do our best to adapt the requirements to the world we live in. And, I think that's why there's a lot of excitement about the LCE project and potentially the separate standard, in that there might be a little more empathy for the differences in practice specific to LCEs. It's hard to pin down kind of definitionally, but I can tell you practically it is quite different, and I think we've talked about a lot of the specific differences. There is a bit of a convergence of fraud and going concern in a small entity, and I'll just call it a small entity, because that's really the area that I deal with. In that, and I didn't respond to the last question in the context of going concern, because I'm not sure there's anything kind of practically in 570 that doesn't really work for a small entity, other than, in both of these standards, we're required to ask management for their assessment of fraud risk, their assessment of going concern, and there just typically aren't anything. There's nothing formal for that. Certainly, when you talk to an owner manager about fraud, they have a very good sense of fraud that could be perpetrated against them or against their company, and they can share that. They often don't really even understand the concept of going concern, so often we end up in kind of an educational role trying to explain that we have to kind of predict out a year, and that leads to some interesting conversations, and it can be, and I think Jenny said this well, both of these are very, very sensitive issues, particularly when there is a problem or a perceived problem. So, and to speak specifically to going concern, where there's kind of clearly not an issue or clearly an issue, hard to do. It's in that kind of very smaller gray area where there's a potential going concern issue or a material uncertainty, a business that's maybe in decline but not in immediate risk of failing. Those can be really difficult conversations, and they can be very, very personal because you're dealing with an owner manager's ego and sense of identity, and often their family assets are at risk. And so I can see auditors being reluctant to want to challenge people on those issues, and I think we do it because we know we have to. I'm not sure how that. Again, I go back to some of the soft skills that I think are very, very helpful for auditors to have. That maybe is something that it obviously doesn't belong in standards, but the guidance material, interview skills, and that kind of stuff, how to draw people out, asking questions. I know I'm kind of all over the place, but I think what I'm saying is we read the standards, and they're not kind of purpose built for the type of world that I live in, but I can take what's there and I can figure out how to apply them more practically in the world that I live in. I think I would benefit from, and I'm hoping maybe the LCE project will get there, where some of the requirements and the two standards that are very process driven, if those were more kind of generalized, I would then be more free to apply those requirements more practically in a way that works better for the practice that I live in. So I'll just leave it there. Thank you.
Thank you, Gordon. And Michael?
I agree a lot with that last statement that Gordon made. One of the things I just wanted to highlight with respect to the difference in procedures, and this kind of brings in the notion of professional skepticism, and what we have in this, in the standards related to skepticism, particularly as it relates to 240 and fraud, is unpredictability of procedures, and I suspect that in an LCE that's very difficult to operationalize because there isn't, it's a pretty straightforward audit. So how am I going to bring that in? So where can I bring in that important notion of skepticism? And I think that's part of the paper, and it'd be interesting to see what comments come back in that with respect to the notion of having an inquiring mind and being skeptical. But I think one thing that you from a difference in procedures with a more complex entity, it's easier to be more unpredictable, to select, for example, in a group audit, go to different locations and spread that around. So I think it's an important aspect of fraud, especially when you've got dealing with a long-term audit where you have a lot of trust in folks who are doing this and things like that, to not lose sight of the need to be unpredictable. And I guess it is sensitive, as Gordon said, because you're like, well, why do you need to look at that? Why are you doing that different than you did last year? Because everybody's used to the same. But I think it's an important aspect to discuss and to bring into the notion. While the procedure might be different in LCE, the notion of unpredictability and skepticism is still important. So, thanks.
Thank you, Michael. We're receiving comments on this question, but if you have more general comments relating to fraud and going concern, you can also raise your hand, as this is the last question we're on, and then we still have some time alluded to this roundtable. So next comment is from Joanne Schroeder.
Thanks, Kai. Something that I just was reminded of again is that, especially in South Africa, the difference between your listed big companies who have very tight reporting deadlines and they must report to their listing regulators within 3 months or 4 months after year end. They often, well, firstly, they've got all their budgets and their cash flow forecast and whatnot prepared properly. But more than that, the current requirement in the going concern standard to say that the entity must prepare these cash flow forecasts for at least 12 months after the balance sheet date or the financial year end makes sense in that regard. But for the less complex entities or the owner managed guys or the small entities, regardless of what the legislation may be, the reality is that very often these guys don't actually get their financial statements done within 9 months, sometimes 12 months. And I can probably give you a bunch of examples where these guys have years of financial statements that are outstanding. So in those cases, it makes absolutely no sense to only consider whether this entity will be in operation for 12 months after the balance sheet date, because that's already either come and gone, or it's only 2 or 3 months down the line. It's going to be of no value to the user if the auditor has only considered whether this entity will probably still be around in 2 or 3 months' time. Now, it's very interesting actually, because a previous version of the standard, and it may have just been the South African standard because I was still studying back then, actually required that the auditor should consider 12 months after the date of the audit report. And I've had a few more senior persons who had actually kind of, I wouldn't say, let's call it disagree with me about what the requirement of the standard is, and insisting that the standard requires 12 months after audit report date. So much so that I had to go and ask one of my colleagues, who then helped me and said, no, but remember, it was the old standard. These people obviously just haven't read the actual standard in recent years. But in the less complex entities, I think it may actually be more, well, obviously more relevant, but maybe to even make that paragraph more clear to say, listen, not just really, really exceptional circumstances, but very often we need to look at 12 months after balance sheet date. The paragraph does say 12 months after balance sheet date, and then consider if it's necessary for longer. But it's almost like not really an afterthought, but it's not obvious enough if you read quickly, and then someone may miss it.
Thank you. Are there any other comments relating to this question, or any general comments relating to going concern or fraud that you haven't shared yet? Jenny?
Yeah, I was just listening to some of the previous speakers, and it occurred to me that the way that ISA 570 is phrased at the moment, and the way that it works, is as auditors we almost get into this sort of very black and white conclusion. So either everything's fine on a going concern front, or you've got, you know, such fundamental uncertainty and issues that you need to draw users' attention to it in your audit report, or it's not even a going concern. And there's a huge grey area of, well, everything's not ideal, or it doesn't really consider the other sort of situation where for many LCEs, it will be a matter of choice whether the business continues. It's not a case of it's in trouble or it's going to run out of money or whatever. It's the choice of the owner to continue trading, particularly for sort of lifestyle businesses where, you know, they might just decide, I'm going to retire early next year and pull the plug on the business. And there's no way of sort of describing well, I mean, you can put circumstances in the financial statements, but, you know, many, I think, directors and those charged with governance are reluctant to do so, because often then that will trigger the audit report paragraph, which, as many, you know, have already said, you know, rightly or wrongly is perceived as, oh my goodness, the business is on the brink, and it can be the self-fulfilling prophecy. And I wonder if we need somehow, whether it's through disclosure or some other option for the audit report, to be able to draw users' attention to pertinent facts that are relevant, but maybe, you know, wouldn't actually trigger the fundamental uncertainty. Particularly I'm thinking of, so where you're dependent on someone's goodwill, whether that's the owner or a parent company who may be providing financial support. In the not-for-profit sector, where you get charities that are, you know, highly dependent on typically multi-year grants, and if the grant provider pulls the plug, well, that's end of charity. You know, there's nothing fundamentally wrong with the charity, but it's completely dependent on a third party. Now, whether or not you should be using at the moment a fundamental uncertainty, you know, and raising that uncertainty, probably yes, but I know a lot of auditors shy away from that because, you know, it doesn't mean that the entity is, you know, fundamentally in trouble in that sense, and it's out of their control. So there's often this sort of reluctance to go down, you know, the mention in the audit report. And whether, I don't know quite what that other thing would look like, but I think we need some other mechanism to give more information to users without, you know, the sort of blunt instrument of, you know, Houston, we have a problem. I mean, a major problem here, because there is some middle ground quite often, I think.
Thank you. Gordon?
Thanks, Kai. I think Jenny raised a good point that I was thinking of, and it came from a comment earlier as well, that often LCEs are really dependent on, often it could be a small group of key employees, not always the owner, depends on the type of business, that have a key skill or have the key relationships, and they become very, very dependent on that one person or that group of people that, you know, a sudden health issue could bankrupt a pretty successful business. And I'm not sure the model, and this is not an IAASB issue or an auditing standards issue, it's really a framework issue, doesn't really sort of contemplate that sort of thing where the goodwill isn't owned by the entity. It's really, it's owned by the key people that show up every day to do the work. And if they were to suddenly or die or quit, retire, you know, that becomes existential, and it can become existential pretty quickly. And I think one of the truths of going concern, and we're kind of all living through this pandemic, is that the predictable things are predictable, and the unpredictable things often are the ones that take companies down. And, you know, I'm not sure, you know, I've had this debate, I guess, in practice and in particular circumstances where, you know, our auditor is expected to have a crystal ball and be able to predict the future in terms of this 12-month thing. I mean, clearly no, but I do wonder if the framework should focus in this sector more on disclosure of kind of some of these key risks so that users can sort of better understand and apprehend them. Versus the existing model, which is sort of more on an expectation that the business can just continue on no matter what, because that often just isn't the case. Thinking about fraud, I mean, if I had to pick between 570 and 240, the one that provides more kind of issues or difficulty in application, for me, it's going to be 240. As I said before, and I think it's true, the 240 kind of deals with fraudulent financial reporting or fraud committed by the entity or by management, and also fraud against the entity. And I wonder if it would be helpful or meaningful to actually break, I mean, they're very different. You deal with them differently. I wonder if they really shouldn't be in two different places, in two different standards, and really get the focus on each of them separately. They are different. I mean, they both happen to be sort of types of, arguably types of fraud, but the circumstances, the impact, the way you deal with them, or at least the way I deal with them and think about them as an auditor, are very different. And, you know, clearly fraud within a company is much more driven by controls and processes and people and systems, and, you know, more of a 315 type of thing, where fraudulent financial reporting is a little more of a meta level type of consideration. It obviously would consider those things in risk assessment, but you sort of need to come back to them, you know, in forming your conclusion as well. And it does tie in directly to going concern when you get into a business that's failing or struggling or having issues, in that they do become almost the same issue in some circumstances, and sort of tying those together in some way. I mean, I think we do it in practice, but, you know, maybe it could be done in the standard in some way that might be helpful. Thanks.
Thank you for sharing those interesting views. I see no further hands or comments. Thank you all for participating and sharing your views. We'll hand back to Tom for some final remarks. So Tom, over to you.
Thank you, Kai, and thank you to everyone for joining us today. This is, as I said, the third of our 3 roundtables on fraud and going concern. We also touched on auditor reporting, but I think we even mentioned today that they're all highly linked together, and so this has been very useful to us and the team as we try to get moving on these important topics. I also wanted to thank Kai and the team for all their work in preparing for this event. I know that I saw lots of writing and board members nodding on this call, so I know how important it will be to guiding our future discussions. And most of all, thank you to the participants and the observers on YouTube. We will certainly keep everyone posted on our thinking on this topic. I think we talk about external communication and the role of our standards, but it's our role too to communicate with our stakeholders and keep you posted on our work. So with that, I wish everyone the best. Stay safe, stay healthy, and keep following us. We appreciate your participation. Thank you.